The rising appetite of exchange-traded funds in Australia has seen them transition from being what was once a niche offering to very much an increasingly mainstay offering in local investment portfolios. Joining me today is BetaShares Managing Director Alex Vinokur to discuss the growing maturation of exchange-traded funds in Australia, as well as the key trends and developments that we can expect to see in this space in the coming years. Alex, thank you for joining us here today.
Great to see you, Daniel.
Alex, firstly I'd like to begin by asking you, what is the holy grail when it comes to exchange-traded funds for local investors, and how can we see, I guess, what are they looking for in this present economic climate as well?
Sure. Look, I'm probably a little bit, sort of too old and skeptical to believe that holy grail exists as a concept, but needless to say, the ideal scenario for an investor is one where they are able to look at their investment portfolio as a source of comfort, basically, at retirement. And the journey from where they are today to that period of time is obviously a journey, which is not in a straight line. It's not a path from A to B. There are declines in the market, there is growth in the market. Importantly, investors need to be comfortable with the level of risk in their investment portfolio to make sure that it's commensurate with their own sort of risk appetite. But first and foremost, it's ensuring that investment portfolios can provide for a comfortable retirement. So ETFs are not the holy grail, but we certainly believe that ETFs have a very strong role to play to help investors build more diversified, more robust investment portfolios, and ultimately the types of investment portfolios that can deliver for a comfortable retirement for investors.
And when we look at the way in which this market in Australia has evolved, can you tell me why Australia perhaps has arguably lagged behind its global counterparts when it comes to ETF investing?
Yeah, look, Daniel, that's a great question. It's a question that we have been thinking about for a very considerable period of time, before starting our business in Australia 6 years ago. I believe there's a number of reasons, and probably no single factor can be really looked at as the factor. I would say first and foremost, the range of product that has been available in Australia historically has not really been supportive of a significant growth of the industry overall. ETFs have started over a decade ago, but have really started with a few very niche offerings. If you look at the market today, we've got well over 100 exchange-traded funds available in the Australian market. Today, Australian advisors and investors can build portfolios comprising of Australian equities, international equities, cash, fixed income, currencies, commodities, alternative exposures, managed risk exposures. So the ability to construct a portfolio today is certainly very different and significantly greater than it was historically. Education is another key factor. Education takes time. Australian ETFs have been around for over a decade, but relative to, say, traditional managed funds, it's still a reasonably short period of time. And what we're seeing is that over the years, the extent of the adoption of ETFs in the Australian market is certainly growing quite considerably. Another factor that I would probably mention in the context of of your question is the fact that asset allocation has really emerged basically as a primary driver of investment returns in the minds of Australian investors. Investors are moving more and more towards asset allocation as the key driver of investment returns, and in some ways further away from believing that active management in terms of stock picking, for example, should be relied upon as the principal driver of investment returns. So it's education, it's the product range, and the fact that asset allocation comes to the fore. In the context of all of those, I would say ETFs once again have a significant role to play.
Now, education is a very interesting point, particularly as I think that given the context that we find ourselves in with all this discussion surrounding the professional educational standards for advisors, and the series of statements and policy reforms, I guess, that we have before us. But Alex, just how important is education when it comes to driving the uptake of exchange-traded funds, particularly when we look at it from an advisor education perspective?
Absolutely. Look, there's still a long way to go for the industry in terms of the education effort. And I also believe there is a long way to go for advisors in articulating the value proposition that ETFs can deliver to the end investor. So let me just take sort of a few examples. On the one hand, we still have a significant number of advisors in the Australian market that we're having very early conversations about what ETFs are and how they fit into investment portfolios. And of course, that conversation is a great one to have because, as a fund manager of ETFs, we can go into the detail about the low cost nature, the transparency, the diversification benefits. And the fact that all of these benefits come without compromising on the performance, given that 75% or so of active managers actually underperform the benchmark net of fees. So that's a really exciting conversation to have, and there's still a lot of conversations along those lines that we're having in the market. At the same time, we are now seeing that over 50% of Australian advisors are now adopting ETFs. So their level of education is actually pretty significant, today. And with those advisors, the conversation is actually not the ETF 101 as to what the ETF is and how it fits and how you can use it to benefit your clients, but it is really more how can ETFs can help you, the advisor, run your business more effectively. How can they help you look after your clients more effectively? How can you construct portfolios which can be tailored to various types of clients in terms of various risk-return profiles? Those are pretty interesting conversations. So we are going beyond the traditional sort of core satellite conversation that use the ETFs as the core of your portfolio, as the low cost, it's the bedrock of your investment returns, and you can use active managers, for example, or you can use more tactical ETFs as your satellites. We are now at the same time having conversations which are more around how do we manage risk in portfolios using exchange-traded funds. How do we segment client risk appetites and deliver those outcomes using exchange-traded funds? So ultimately, the exchange-traded fund industry has obviously grown over the last decade or so to now being able to cater to a variety of risk appetites and variety of investment objectives. So there's still a long way to go.
And you touched upon there, I guess, the growth of the ETF industry, and it's been 15 years since the first exchange-traded fund product was traded in Australia. Alex, can you tell me about some of the key lessons that you've learnt during this period, or some of your key reflections in this time as well?
Yeah, look, I would say, Daniel, probably first and foremost, I would say that when the ETF industry had started sort of emerging in the Australian market, the debate has really been focused on active versus passive. It was almost an antagonistic sort of approach, basically, where the discussion was all around how active managers cannot deliver value and how sort of passive all of a sudden was going to take over the world. I mean, we certainly at BetaShares believe there is space under the sun for both active managers as well as index-based solutions. And I think the real trigger for the increased adoption of exchange-traded funds in the Australian market has been that recognition that advisors and investors do not have to choose between active and passive. Of course, there is a lot of data which supports that certain pockets of active struggle to outperform the market. There are also pockets of data which show that certain pockets of active outperforms the market in certain conditions. I think the key is that education message around the fact that it is not one versus the other. ETFs have a role to play. They can help investors lower the cost in their portfolios. They can help investors diversify within the asset class and across asset classes. They can coexist happily, with active management, and they can be blended, and advisors can blend the exposures depending on the objectives that they're setting out for their clients. So I'd probably say, that's lesson number one, sort of for ourselves as well as the industry as a whole. I think the other lessons are really sort of more around the fact that of course success for any industry is not an overnight phenomenon, right? Success takes time and it requires real commitment. So we've been in the market sort of supporting the growth of the Australian exchange traded funds industry, for the past 6 years. Education, as you've pointed out, is absolutely critical. And as I was saying before, it's educating the advisors on the one hand, but really helping the advisors to articulate that value proposition down to the, sort of to the end client. It's ensuring that they understand what ETFs can bring to the table. So all of those would be, relevant lessons basically in this context.
And finally, I guess what I wanted to ask as well, and to hear more of your thoughts on, is as we look at the trajectory in which the Australian ETF industry undertakes and the way it's moving forward, what do you foresee as being some of the key trends and developments in this space in the coming years?
Look, always difficult to gaze into a crystal ball, of course, but I'll attempt nonetheless. I would say we feel that the domestic bias in Australian investment portfolios is going to be gradually reducing over time. I think despite sort of significant efforts by financial advisors and by fund managers such as ourselves, Australian investment portfolios are still have a long way to go in terms of achieving true diversification and true alignment, with the investment objectives that most investors are setting out for themselves. So I would say reduction in the domestic bias, which really means increased allocations to global equities, increased allocations to fixed income, increased allocation to alternatives, asset classes which have low correlation to the traditional asset classes. We think there's still a long way to go in that regard. We certainly hope that a large number of the SMSF market, which is well over $500 billion in Australia today, a larger portion of those investors will start obtaining investment advice. When we look at the asset allocation, in particular of the SMSF investors, there's still a long way to go. Sort of in that regard. I think the size of the ETF industry will continue growing. The growth has been approximately 50% year on year over the last few years. We do not think that trajectory is about to change any time. We do believe that ETFs will continue growing as part of the Australian portfolios. We're seeing that over 80% of Australian advisors that have adopted an ETF express a strong desire to increase their allocation to exchange-traded funds over time. To us, that indicates that investors tend to have a positive experience with exchange-traded funds, and that certainly has been translating, as we were saying, in the growth statistics in the industry overall.
Alex, thank you so much for your time.
Thank you, Daniel.